Hello and welcome to a lecture video. In this video I want to finish up chapter 1. Chapter 1, if you recall from Tuesday, uh, we talked a lot about the difference between financial accounting and managerial accounting, the difference in the users, right? Managerial accounting is used primarily by, or managerial accounting information is used primarily by managers, right? Those that are inside the company. Financial reporting obviously is geared more towards decision makers outside the company, stockholders, creditors, banks, lenders, whatever. And then we spent a good deal of time working through the cost classifications, right? And if you remember, we said we had a cost classification based on traceability. And we said we have indirect costs and direct costs. And then we looked at manufacturing costs versus non-manufacturing costs, right? And we said the manufacturing costs are our direct material, direct labor, manufacturing overhead. And we said our non-manufacturing costs were our selling and administrative costs. And then we said, well, hey, we have another classification for financial statement purposes. And we have what we call product costs and period costs. And we said, okay, well, our product cost is really just a synonym for our manufacturing costs, right? We're just looking at it through a financial reporting lens, and we're taking our manufacturing costs and saying, oh, they're product, right? The non-manufacturing cost, the selling and administrative, when we look through that lens of financial reporting, we say, oh, those are our period costs. And then we got into cost behavior, right? How do costs behave? And we said there are three ways the costs behave. We said they can behave in a fixed fashion. We said they can be variable. Or the third one, we said, maybe they're a combination of the two. Maybe they're mixed, a little bit of fixed and a little portion of variable. And we worked on the exercises, went through all that, but we didn't get to cover the income statements. So what I want to do in a short video is I want to go through the difference between the traditional and the contribution formatted income statement, and I want to finish. I believe there's two. I think two problems in the in-class assignment. Yeah, there's two. Or nope, I'm sorry, there's one. Yep, just number 6. So we're going to do number 6 so you can finish up your study guide, and then when we meet, not next week because next week we have EIAs, the week after, just turn that into me and we'll be good to go. Okay, so the traditional income statement, I'm hoping this is going to be a review. I know a few of you guys had mentioned the Harvard Business Review and you were none too pleased with that. So I'm going to go through the traditional statement. I'm going to take a little more time. If you don't need it, just speed through the video and get to the contribution margin part. Not a problem. But first thing we're going to look at is the traditional format income statement. That's on the left. Okay. And the traditional income statement we use primarily for external reporting. Well, let's think about that. Who are we reporting to? Well, those that are external to our organization, stockholders, creditors, lenders, the government, whoever, right? So that means that we're going to be using the cost classification for financial statement purposes. We're going to have our product costs and our period costs. Okay, so how we prepare the traditional format income statement is we take our sales and we subtract out our cost of goods sold. Okay, cost of goods sold are really our product costs, right? Those are those manufacturing costs because they're synonyms for one another. So that's like the direct material, the direct labor, and the manufacturing overhead. Once we subtract out that cost of goods sold from sales, we end up with gross margin, right? Gross margin is what is left over after we subtracted out our cost of goods sold. It's what's left to cover our period costs or our non-manufacturing costs, which are selling and administrative costs, right? Once we subtract out the selling and administrative or the period costs, we end up with net operating income. Pretty simple, very straightforward. The main takeaway here is just recognizing that, okay, I have to kind of think about the classifications for financial statement purposes, and I need to worry about product costs and period costs. Okay, now the contribution formatted income statement, we are going to be using this throughout the entire course pretty much, especially when we get to chapter 5. Okay, and we'll also use it when we get to chapter 8 when we start doing some differential analysis. So here's how I remember the contribution formatted income statement. Okay, I like to think that it's bad, right? It's racist, it's sexist, it's just a bad statement. Why? Well, because it segregates based on behavior. Okay, the contribution format segregates costs based on variable and fixed. Okay, so just like the traditional income statement, within the contribution formatted income statement, we got to start with sales. Okay, then we subtract out all the variable costs. Okay, we do not care if it's considered a product cost or a period cost. All we care about is how that cost behaves. Okay, so when we do the contribution formatted income statement, we need to look through that lens of behavior and say, okay, let me pull all my variable expenses and I'm going to subtract that from sales. Once I subtract my variable expenses from sales, I end up with what we call the contribution margin. Now this is very important, and we're going to see this a lot when we get into CVP analysis and differential analysis. We'll use the contribution margin. It's our jump off point, or it will be our jump off point whenever we start making decisions in differential analysis. But for right now, we just need to know A, what it is, and B, why it's important. So what is it? Well, the contribution margin is basically defined as it is the money that is left after we have deducted variable expenses, and it's what's left to cover any fixed expenses and hopefully provide us for a net operating income. I'll say that again. I know it's recorded, you can rewind it, but I'll say it again for you. What is contribution margin? Well, it's what's left after variable expenses have been deducted from sales, and it's what's left to cover fixed expenses and hopefully provide for a net operating, hopefully provide income for us, or net operating income. Okay, again, contribution margin, totally used by management. That's the primary use for it. People outside the company probably aren't going to see this. Okay, and that's how you put together the contribution formatted income statement. And again, it's very important. Why? Because we're going to keep seeing this. I already mentioned we're going to see it in CVP analysis, right? Which is chapter 5. We're going to see it in segment reporting and profit data in chapter 6. We're going to see it again in chapter 8 when we do some budgeting. And we're also going to see it in chapter 4 when we do some differential analysis, making special order decisions. Okay? So that's pretty much the end of chapter 1. Now, what I want to do now is go through or cover really the last question, question 6, within the in-class assignments. Okay, I'm hoping that you did try this on your own. If you didn't, please pause the video, because we just went over how to compare it, or how to prepare the traditional and the contribution income statement. Just give it a try for me. That's all. I'm going to give you the answer, obviously. The idea is to get you to think, work with the material, and try and discover how to do it. If you haven't done that, pause the video, give it a shot, come back, and we'll go through it together. Okay, so let's look at, there we go. So what we have here for number 6, we have number of units sold, selling price per unit. They give us the variable selling and administrative. They give us the total fixed selling expense. They give us the total fixed administrative expense, and they give us beginning merchandise inventory, ending merchandise inventory, and they also give us merchandise purchases, right? That will allow us to figure out what our costs of goods sold are. Okay, so I already gave you a nice little template to start with. This is proper form. Notice there's three what do you call them, rows, right at the top, because we want to make sure we do this in proper form. So proper form would be, first would be the company name. Okay, I don't think this problem gave us or Cherokee Incorporated, so we would put in Cherokee Incorporated. We would say, what statement is this? Well, this is the traditional income statement. And we would give a period, right? What time frame does this cover? Well, it doesn't tell us. So we can just say for month ending August 31st, 2019. Okay, doesn't matter, we're just making it up really. All right, so first thing we need to do is figure out what are our sales. Well, they don't tell us really what our sales are, but they give us enough information, right? We know that we sold 20, oh, let me do it this way, sales 20,000 units at $30 a piece. Well, that means our sales have to be 600,000 if my math is right. Okay, the next thing we need to do is figure out what are our cost of goods sold. Now I'm going to abbreviate this as COGS, C-O-G-S, cost of goods sold. That's something you should know. You should know that COGS is considered cost of goods sold. It's just kind of a, I guess maybe like an accounting shorthand for cost of goods sold. Instead of writing it out or saying it, we just say, hey, COGS. So we need to figure out what is our cost of goods sold. They don't tell us. They do not tell us in the problem, but they give us enough information to figure out, right? We know our beginning inventory. Actually, I'm going to come down here and do it. We know our beginning inventory is $24,000. Okay, so at the beginning of August, we had $24,000 worth of merchandise. Okay, through the month, we added $180,000 of inventory. Okay, so basically what we're saying here is that during the month, since we started out with 24,000, we add 180,000. That means throughout the month we have $204,000 worth of merchandise to sell. Okay, I took my beginning and I added my purchases. But we're at the end of the month, right? We counted our inventory and we said, oh no, I don't know how much we sold, but we only have $44,000 worth of inventory left. So I'm going to subtract out that $44,000 worth of inventory. Okay, and when I run those numbers, my cost of goods sold should be $160,000. Okay. If you're a little confused on how I took the merchandise inventory account and said, oh, I can figure out what our cost of goods sold are, right? What I did was I took the beginning balance, I added the purchases that we made for merchandise inventory, and I subtracted out what was left, or the ending balance. That tells us how much we've used. Okay, so again, beginning plus purchases minus ending inventory, that tells us what our costs of goods sold are. Okay, and if you remember, the next thing we need to do is to figure out what our gross margin is. And it looks like I didn't put enough I apologize, on here it goes to a second page. So I'm going to go ahead and put in my gross margin. Okay, gross margin is sales less cost of goods sold. So $600,000 minus $160,000 should give me $440,000. From my gross margin, I need to subtract out my fixed expenses. So I need to put my fixed, I'm going to go to the second page and I'm going to put in my fixed expenses. Well, the first one I have is selling. Okay, so how much are my selling expenses? Well, you might look at our numbers. I'm going to scroll up and you might say, oh, total fixed selling is $40,000. You would be correct. But it's not the total selling expense, it's the total fixed selling expense. Okay, in this example here, selling expenses as well as administrative expenses are actually mixed costs. They have a portion of fixed and they have a portion of the variable. So we have to include all that when we're calculating our total selling expense. So let me go back down here. Okay, and basically here's the calculation. The first thing I need to do is recognize that I had a $4 per unit variable selling expense. Okay, so if I take $4 times 20,000 units plus, that's the variable portion, plus I'm going to add the $40,000 of fixed expenses, that gives me my total selling expense, which ends up being $120,000. Okay, very important that we take the variable portion and the fixed portion. Okay, now we need to do the administrative expenses, right? Well, we do that the same way. We know that our administrative expenses, or our administrative expense, is it's mixed, right? Has a portion of variable, has a portion of fixed. So to do that, I'm going to take my $2. Where did I get the $2? Well, the problem tells us variable administrative expense is $2 per unit. So I'm going to take my $2 times my 20,000 units that I sold, and then I'm going to add the fixed portion of the administrative expense, which is $30,000, and I end up with, there we go, I end up with $190,000. Is that right? No, 100. It's actually 70,000. Sorry about that. It's 70,000. Okay, so now I have my net income, or I can calculate my net income. Well, that's easy, right? I'm going to take my gross margin of 440,000, subtract out my selling and administrative expenses from my gross margin, and I'm going to end up with $250,000. Oh, $250,000. Okay. Now, that's the run through of how we do the traditional formatted income statement. Hopefully, Hopefully that was a review. If not, if it's still a little confusing, please reach out to me. I have no problem helping you guys out. You just got to let me know what you need. Okay, so now we're going to do the contribution formatted income statement, right? And remember, we don't like this statement, or we don't like this because it's bad. It segregates based on behavior, okay? So, first thing I'm going to do is make sure that it's in proper form, right? Meaning, I'm going to make sure that I put in my company name, Cherokee Incorporated. What are we doing? Well, now we're doing the contribution format. Oh, and I'm going to abbreviate and say IS for income statement. Again, what period are we doing? Well, they didn't tell us, but we're just going to say for month ended August 31, 2019. Okay, so we're going to start off with our sales, right? Well, sales didn't change. We're still calculating sales the same exact way, right? 20,000 units times $30 still gives me 600,000. Okay, now I need to figure out, okay, what are my variable expenses, right? Well, we're going to assume that our costs of goods sold are strictly variable, right? Which technically they are, right? Because the more we sell, the higher our cost of goods sold, is. The less we sell, the lower it is, right? So in a merchandising company, costs of goods sold are going to be variable, okay? So I need to figure out, what are my costs of goods sold, right? Well, remember, we take the beginning, we add what we purchased, we subtract out the ending. That tells us how much we used. So I'm going to take my beginning, or my beginning balance of 24,000. To that, I'm going to add the purchases, which we said were 180,000. And then I'm going to subtract out the ending. I'm going to subtract out the ending balance of $44,000. That should be 160,000. Okay. Next, I'm going to take, let me go down a little more here. Okay. Next, I'm going to say, what's my next variable expense that I have? Well, I have a variable, and I'm going to abbreviate that with a V. Variable selling. Well, what was our variable selling? What was our variable selling expense? Well, if you remember, it was $4 times 20,000 units. Which gives us $80,000. Yeah, gives us 80,000. Okay. The next variable selling expense the next variable expense we have is our variable admin. And we said that, hey, it was $2 per unit sold. Well, $2 times the number of units sold, which is 20,000 units, gives us 40,000. Okay, so next we have the contribution margin. Okay, and I'm going to abbreviate that as CM. Okay, because you're always going to see CM. Right? What's the CM? Meaning, what's the contribution margin? Okay, well, we can figure that out. We have our sales, which are $600,000, minus all the variable expenses. The cost of goods sold, 160,000, minus the 80,000 of variable selling, minus the 40,000 of variable administrative. That's 320,000. Okay. From here, I need to subtract out my fixed expenses. So I'm going to abbreviate and say F for fixed selling, which they told us in the problem was $40,000. Oh, sorry. And then I'm going to take my fixed admin or administrative expenses, and the problem told us that that amount was $30,000. So that means fixed expenses in total are just $70,000. Okay. So I now end up with, I can now figure out what my net operating income is, and that is $250,000. Okay. Now, notice what happened here. There is the only thing that's the same between the contribution formatted income statement and the traditional formatted income statement is the net operating income, right? Net operating income under the contribution format is $250,000. Under the traditional format, it's still $250,000. The only thing, or what's different, there's two things that are mainly different. Number one, tradition uses product and period costs. In the contribution formatted income statement, we segregate based on behavior, so we segregate out variable and fixed. That's one difference. The other difference is that middle ground, right? In the traditional formatted income statement, let me get up there, we have gross margin, right? On the contribution formatted income statement, there's no such thing as contribution margin, or I'm sorry, there's no such thing as gross margin. Contribution formatted income statement, we have the contribution margin, okay, not gross margin. So those are the main two differences. Okay, so you should be good to go to finish up your in-class assignment. Just finish it up, hold on to it, turn it into me when we see each other the week after next. Okay, I will be working on posting chapter 2 and chapter 3 materials. That will be ready to go for you by Tuesday night. Don't forget, Tuesday night you have your either Connect assignment or your textbook assignments. I did post those within Moodle, so either one of those are due Tuesday. The Tuesday coming up here. If you did Connect, you don't need to turn anything into me, but if you do your textbook problems, you have to submit them via Moodle, and I'll grade those, give you feedback, and give you an opportunity to earn back any points that you may have missed. Okay, so again, I cannot stress this enough. I am here for you. I'm here to help you. Whatever you guys need, you just need to text me and let me know. More than happy to to work with you and get you where you need to be. Okay, so thanks for tuning in. Keep an eye out for chapter 2 and 3 material, and I will see you in 2 weeks. So have a great weekend, and we'll talk to you soon.